Very good evening and welcome. You're watching the India Development Debate with me, Tamanna Inamdar. The big news today is the Reserve Bank of India's MPC meet outcome, where the top bank has decided to keep the repo rate unchanged at 6.5% yet again. This comes as a relief for home loan borrowers who saw a steep rise in their home loan interest rates within a span of just 10 months when the central bank raised the repo rate by a total of 2.5%. That's 250 basis points in all. We've now seen two consecutive pauses in the repo rate hike. Can borrowers finally breathe a sign of relief? Are these two consecutive pauses in repo rate hikes a signal for the end of the current rising interest rate cycle? And while the RBI maintains it's more focused on taming inflation, will interest rates cuts follow soon? What do you make of the fact that while interest rates have not been increased this time, the stance of the RBI is not yet neutral? They have retained their withdrawal of accommodation stance. So what does that really mean? We're going to be talking about all of this on the show, but first let's listen in to some of the key points made by Governor Shaktikanta Das.
Based on an assessment of the macroeconomic situation and outlook, the MPC decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility and the bank rates, they stand at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. India's real gross domestic product, that is real GDP, recorded a growth of 7.2% in 2022-23, stronger than the earlier estimate of 7%. It has surpassed its pre-pandemic level by 10.1%. Real GDP growth in the fourth quarter of 22-23 accelerated to 6.1% year-on-year from 4.5% in the third quarter of last year, aided by fixed investment and higher net exports. Looking ahead, higher Rabi crop production, expected normal monsoon, continued buoyancy in services, and softening inflation should support household consumption. On the other hand, given the healthy twin balance sheets of banks and corporates, supply chain normalization, and declining uncertainty, conditions are now favorable for the capex cycle to gain momentum. The real GDP growth for 2023-24, that is for the current year, is projected at 6.5%, with Q1 at 8%, Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%, with risks evenly balanced. Headline CPI inflation has come down during March-April 2023 to 4.7% in April, the lowest reading since November 2021. Monetary policy tightening and supply-side measures contributed to this process. The easing of inflation was observed across food, fuel, and core, that is the CPI excluding food and fuel categories. That means all categories of headline inflation witnessed easing of the inflation pressures. Going forward, with the recent Rabi harvest remaining largely immune to adverse weather events, the near-term inflation outlook looks more favorable than at the time of the last MPC meeting in April. Taking into account these factors and assuming a normal monsoon, CPI headline inflation is projected at 5.1% for 23-24, with Q1 at 4.6%, Q2 at 5.2%, Q3 at 4% and Q4 at 5.2%. The risks are evenly balanced. The decision to pause was based on the need to assess the cumulative impact of past monetary policy actions while charting out our future course. Subsequent incoming data suggest that while risks to near-term inflation have moderated somewhat, pressures remain during the second half of the year, which needs to be watched and addressed at the appropriate time. At the same time, given the uncertainties, we need to maintain Arjuna's eye on the evolving inflation scenario. Let me re-emphasize that headline inflation still remains above the target, and being within the tolerance band is not enough. Our goal is to achieve the target of 4% going forward.
All right, to speak more on this, I'm joined today by Anubhuti Sahay, Head of Economic Research South Asia at Standard Chartered Bank, Madan Sabnavis, Chief Economist, Bank of Baroda, Indranil Pan, Chief Economist at Yes Bank, and Kaushik Das, MD and Chief Economist, India and South Asia, Deutsche Bank Research. Welcome to all of you, and thank you so much for speaking with us today on the show. Let me begin with you, Kaushik Das, on your take. I think the pause was widely expected, but what about the fact that the stance of the RBI has remained the same?
Hi, Tamanna. Yeah, so we were expecting a pause, and the stance was also not expected to be changed because, there are many factors. One is because there is still ample liquidity in the system. And if you, notice that for the last 3-4 days, RBI has been actually absorbing liquidity from the banking system. And part of that liquidity has come because of the 2000 rupee exchange program, plus RBI has paid a higher dividend to the government of India. So all that taken together, since there is more liquidity in the banking system, RBI still considers this the state of the economy to be in a kind of accommodative kind of a situation. So they're saying we are in the withdrawal of accommodation stage, not in a neutral or any other kind of nomenclature. So that is also one way to kind of stop market from pricing in an earlier rate cut, because the moment RBI changes its stance from withdrawal of accommodation to neutral means that you can hike rates, you can pause, as well as you can cut rates. So probably the market would have thought then RBI could be, cutting rates in this year itself, and they could have been pricing much bigger rate cuts, which probably RBI wanted to avoid, given that the advanced countries, central banks like US and Europe and all other, many other countries are still hiking policy rates. So I guess what RBI has done with its commentary today is to push back expectation of rate cuts into 2024. We think maybe April of 2024 would be the timing of the first rate cut, and not before that. And RBI has kind of indicated through its commentary in that direction.
Anubhuti Sahay, what do you make of, especially the commentary that came in from the Reserve Bank, apart from the fact that rates weren't hiked, the pause continues, in light of some very, very optimistic data that we've seen recently, especially with the full year GDP numbers?
Yeah, Tamanna. So I think, if we look at this policy, and as Kaushik alluded to it, probably this was not the right policy to go and bring any kind of change. As you highlighted, growth is still holding up pretty well. If you compare India's growth between Q4 of 2022 and Q1 of 2023, there is a pickup in the growth momentum. Contrasted to a lot of ASEAN economies where growth momentum has actually slowed down. So growth in India is holding up, not only in comparison to its own recent past, but also if you compare it to what's happening in most of other economies. On top of it, given that the Monetary Policy Committee has the mandate of keeping CPI in the band of 2 to 6%, the risk which exists to the current inflation trajectory, primarily on the monsoon uncertainty, cannot be ignored. We got a 4.7% CPI print in the previous month. Next week, we are forecasting a 4-quarter on May CPI. this can excite the market that probably we will achieve the inflation target of 4% sooner than what we expected a couple of months back. But this whole downtrend is coming from the food momentum. If you look at the core inflation, that is still elevated at 6%. And if monsoon disappoints, we can very quickly revert to the 6% or the upper threshold of the mandated band of MPC. So I think data is good, both on growth, both on inflation. Probably growth continues, but if we look at inflation, it's too soon to start rejoicing given the uncertainty on monsoon. We have entered that season, so next few weeks will be extremely critical to assess the inflation trajectory, and in that context, the pause was well justified.
So the pause, of course, is well justified, but also the RBI made it clear that it's sort of in wait and watch mode. Madan Sabnavis, do you think that message came out clearly that the central bank is not keen to sort of break out the party hats yet? Yes, the last inflation print has been encouraging. The last GDP full year print has been encouraging, but there is a lot that is still very uncertain.
No, I think it's a very prudent approach for any central bank to take, where you say that we will wait and watch, we'll go according to what the data turns out to be. Because I think a lot of this discussion on inflation is actually based on the fact that there are all these base effects which are coming in. In fact, if you look at the number which you got for 4.7% last month, if you just remove two items which had negative growth, vegetables and edible oils, we actually get inflation at 6.2%. So just like how economists keep playing around with core, I remove two of these categories, let's come up with a number of 6%. So I think the RBI is cognizant of the fact that when we're talking of inflation coming down, it's just a particular number which is being influenced by the base effects. And I think that's one of the reasons why for the first quarter, we have something like 4.6, and then it starts increasing in peaks in the third quarter. So I think when inflation is being driven more by statistical base effects, not really in terms of prices coming down, but we should remember that when we talk of the so-called core inflation, which is based on the maximum retail price, the MRP concept on all the products and services, they never come down. Okay, food prices could come down, but definitely the manufactured product prices don't come down. And whatever little bit we have seen in terms of some of the consumer items are very, very marginal, that don't really make a difference. So it's all the time we're playing around with these numbers, and any kind of a shock which comes in has the capability and ability to actually start increasing these numbers once again. So I think that's the reason why one is looking at a pause. And I think it's a foregone conclusion that the RBI will continue with the pause. And in fact, I think in the press conference, the RBI governor again reiterated that we should not be talking about things like this pivot and all that. I think lots of us are making noise on that. The fact remains that whatever decisions are being taken are taken only for this policy. The market is not supposed to look beyond and keep interpreting merely because he didn't talk about a pivot. It means there's going to be a pivot. So I think that would be the rational way to go about it. And to my mind, I think we'll probably have to wait for the new calendar year before there is a rate cut, provided all the RBI forecasts work out, because you can't do it until the third quarter, because we thought that maybe in October, there could be the first rate cut. But when the inflation is supposed to be peaking at that point of time based on the RBI forecast, you can't possibly have a cut there. So I think that could be happening probably only in the first quarter of the new calendar year, not before that.
Okay, so we are unlikely to see a rate cut before the next calendar year. So that's another 6 months at the very least. Indranil Pan, do you agree with that assessment and the messaging from the Reserve Bank today?
Well, this is one of the rare occasions when every economist is agreeing to each other. And I think everybody who spoke before me did indicate that there is a long pause that is due. And I have no disagreement with that. I think the very critical point that the RBI is trying to make, and the communication is probably very clear in this policy, is that number one, it's no longer a flexible inflation targeting is what they are looking at. They are now clearly focused on the 4%. And if we look at what the inflation projections are for the RBI and assume that those base case assumptions that they are playing out with is the right assumptions, and those inflation outturns actually come out to be true, there does not appear to be any chance of a 4% trajectory during this year, which necessarily means that any chance of a rate cut is possibly obviously shifted to the next year. unless there is something that changes drastically, maybe a very severe slowdown which implicates and has implication for commodity prices globally, and they come crashing all the way down, which doesn't look to be an extremely large probability at this point in time, given that oil prices and everything is holding up, even with China demand slowing. You have sort of supply cuts from certain countries which have come through. So all that taken together, I tend to agree with everybody else that there is a long pause. It's very difficult to highlight the timing of this pause, but given the inflation trajectory that has been built out by the RBI for the rest of the financial year, most likely the pause is somewhere in the next financial year. Can't talk about a cut immediately in the current financial year.
Okay, so your trajectory is the runway is even longer actually, because Madan Sabnavis is saying calendar year, you're saying next financial year, so we're looking at another 9 months probably out before there's an actual cut. What would be the factors to change that view? What are we seeing on the horizon? And I want to come back to Anubhuti Sahay on that 7.2% GDP print. The Q1 outlook is also quite rosy from the RBI. FY24 is 6.5%, so better than the rest of the world, leaps and bounds. Do you think that there is any headwind in the way, or is all looking like smooth sailing from the Indian perspective as of now?
Of course, there are no years where you'll see a smooth sailing. There'll be some headwinds, whether it emanates domestically or globally. So probably, policymakers are well aware of, the speed breakers which they are likely to face. Specifically on growth, RBI is clearly more optimistic. They're looking at 6.5%. We are at 6.1%. The first quarter growth, which you alluded to, it's primarily a base effect, very favorable base effect. We ourselves are at 7.8%, so not much surprise there. And the first quarter performance is the most important reason why we all are forecasting now GDP growth of close to 6% in fiscal year 24. After that, the growth trajectory settles lower towards 5.5% if we are focused on the second half of fiscal year 24. In terms of like whether we are likely to see more tailwinds or headwinds, I would say more headwinds. First, the full impact of interest rate increases is yet to yet to be felt fully by the economy. Secondly, if we look at the global story, we are calling for a shallow recession in US in the second half of 2023. China recovery till now has disappointed. Europe is already slowing. Given that US and China are very important export partners for India, eventually we will see some impact on India's growth, growth too. Last but not the least, the positive boost to overall demand momentum, domestic demand momentum, which we saw as the pent-up demand was released, that has now been exhausted. So a moderation in India's growth is inevitable. There are headwinds, both globally to lesser extent when we are talking about the domestic sources, but 6%, 6.1% kind of a growth rate looks highly feasible to us.
6.1 is Anubhuti Sahay's number. The RBI is at 6.5 for FY24, and yes, Q1 the projection is 8%, which is due to a favorable base rate. I want to take that question to Kaushik Das in terms of the economic outlook and what it's looking like. And what we need to prep for. Also, a bit of this debate growing that perhaps the RBI could have or should bite the bullet and go in for a rate cut. Do we need this Arjuna-like focus on inflation, just to paraphrase and quote the governor there? Is that our biggest concern right now?
So, Tamanna, a couple of things. One is our growth forecast is 6% for FY24. Okay. We are more conservative because of the global backdrop. And as Anubhuti pointed out, that US is supposed to go into a recession probably in the fourth quarter of this year. China is not growing at the pace that people expected. And India's sensitivity to global growth is about 40 basis points. So if there is a markdown in global growth as we go into the next few quarters, India's growth would also be, kind of brought down by about, say, 40 basis points for every 1% drop in global growth. So we have factored that in our forecast. I think the biggest risk for India's growth is from the private consumption, side, which is almost 55 to 60% of GDP. And we know that RBI has hiked interest rates quite aggressively from last year, more than 300 basis points, and part of it is still to filter into the real economy. And that will definitely keep on biting the consumers. And we have already seen in October, December, and January, March, private consumption growth was very weak, below 3% year on year. Now, whether that is distortions due to data revisions or actually the data is weak, but we are seeing private consumption being on the weaker side. And this is logical that if you expect, RBI to hike, if RBI has hiked interest rates so much, you would expect private consumption to slow down. And the slowdown is expected more with a certain amount of time lag, because today, if you hike, it takes impact on the real economy after 3-4 quarters. So FY24 is the time period when you'd expect private consumption to slow down more compared to FY23. And also what Anubhuti talked about, the pent-up demand post-COVID, people traveling, they have had their share of travels, and so you could see on the margin private consumption slowing down, and that could be a big factor pulling down growth. You asked about inflation. What Governor Das today tried to emphasize is that RBI is not just happy bringing inflation back to the target zone of 4 to 6%. They want to go towards 4%. It doesn't need to be exactly at 4%, but they should have sufficient confidence to see the trajectory going towards 4% over a period of time. And then only they will think that their job on inflation is done. And then they will consider cutting rates. On the rate cutting part, I would say a couple of things to watch out for. Our rate cutting cycle probably would be linked with when the US Federal Reserve is cutting rates. I don't think RBI will come and cut rates before the US Federal Reserve does. And at Deutsche Bank, we think the Fed would cut their interest rates first in March of 2024. That is why I have April 2024 as the starting point of the RBI rate cut. Now, if the Fed were to cut rates in 2023 itself, because something happens over the next few months, either inflation comes down quite a lot in US or growth slows down and the Fed is willing to cut before, then you could adjust the RBI rate cut also a little ahead. Otherwise, I think it will be tied with the the Federal Reserve when they're cutting rates. And also, we have done some analysis and seen in the last 20 years, the maximum time period that RBI has held on to a pause period between finishing a rate hike cycle and then cutting is about 11 months. So if February 23 was the last rate hike, 11 months would be somewhere in between January or February when the RBI should be cutting rates. Now, whether February or April is a very close call, but I think if there are any rate cuts, it should happen in 2024. And when RBI cuts, it will be at least, I think, 100 basis points. So we have a forecast of repo rate going down to 550 by the end of 2024, because by that time you'd see inflation slowing down as well as growth slowing down. If growth is holding up so well, there's no question of RBI cutting rates at this point of time.
Okay, so there's no real need to, but we have that base effect, etc., coming in at least on Q1 and also on FY23 numbers. So we've got three assessments now. Madan Sabnavis says calendar year 24. Indranil Pan says next financial year, and Kaushik Das has a similar timeline. I have to ask you, Ms. Sahay, what is your sort of guesstimate or assessment of when the rate cut cycle may start?
We have a prolonged pause call, Tamanna, so we're not expecting any rate cuts in fiscal year 24. So yeah, the probability in our view emerges only in fiscal year 25. Having said that, I would like to highlight that our sense is that if RBI starts cutting rate, it will be a very shallow rate cutting cycle this time. Anything lower than 6% looks unlikely to us on repo rate for a very simple reason, that even if Fed starts cutting rate, it's unlikely to go below 0.75% or 3.5%. Given that global yields have moved much higher than the pre-pandemic level. In the pre-pandemic, Fed rate was closer to 0.25%. And if the bottom for the Fed rate is closer to 3.5%, the room to cut rates very aggressively for emerging markets like India doesn't exist. So even if there are rate cuts in fiscal year 25, our sense is it will be a very shallow rate cutting cycle.
Madan, I must end the chat with you and your outlook on economy. I'm keen to know, what you think about the relatively rosy picture we're seeing on the Indian economy.
So actually, the relative rosy picture we are seeing is again because of all the base effects. Because the 7.2% number, I think it's slightly exaggerated. Because if you actually look at the cumulative growth from the pre-pandemic time, that's a compound average growth for the last 4 years. It comes to just around 2.7. So our estimate is between 6 and 6.5%, based on the fact that we have a normal monsoon, nothing is affected out there. Consumption, of course, we don't have the pent-up demand which helped the economy last year. We don't see that. And plus, I don't really see too much of impact of the higher interest rates on growth. Because if you see, the interest rate, corporate sector, the entire country has been used to a repo rate in the region of around 5.756% historically. So what we went down to 4% was abnormal. So I think what has really been done is we've rolled it back maybe a little higher to 6.5. So I don't think growth is going to be affected on account of higher interest rates. Maybe the models may show that statistically there is some kind of a relationship coming after a couple of quarters, but I don't see that kind of thing happening now. So I think it's generally going to be stable, a growth of 6.5%. Not to get ecstatic about it, it's just a number. I don't really see job creation being very robust. I see consumption being fairly flat, and I don't see private sector investment also taking place. So notwithstanding all these negatives, we'll still end up statistically with this number of 6 to 6.5%.
6 to 6.5% is the broad consensus. Next fiscal year for the rate cut cycle start is the broad consensus. So get used to the pause. This is the second one consecutively from the RBI. This might be the modus operandi for at least the next few MPC meets. Thank you so much to all of you for joining us on the show this evening. Always a pleasure. We'll take a very short break on the India Development Debate, but stay tuned. A lot more coming up on the other side.